For the full year, operating profits, core operating profits, increased by about 20% to 1,188 crores. For the full year, profit after tax was impacted by a one-time charge on account of superannuation of 61 crores that we were required to take in the fourth quarter. After this one-time charge for the full year, profits after tax increased by 7% to 658 crores. If you ignore the one-time charge, profits increased by 14% to 698 crores. I'm pleased to say that the underlying trends behind the earnings were reasonably solid. So both net interest income increased by 14% and core fee income increased by 19%. Our net interest margins for the full year was steady compared to the last year at 3.52%. But we actually saw a very good trend in the fourth quarter, where the net interest margin in the fourth quarter increased to 3.74%, which was a sharp increase compared to the December quarter, where it was only 3.35%. Growth was somewhat muted last year. So overall customer assets increased by 12%. If you break this up into our wholesale bank and the retail bank, our wholesale assets actually shrunk. They degrew by 2%. However, the retail book, which is roughly 65% of our loan book, the retail book grew by 22%. This was on the back of an extremely solid showing in our SME, business banking area, as well as our agricultural area. Home loans, mortgages were reasonably steady. In terms of asset quality, again, as I said, it's a difficult environment. We saw, compared to the previous year, we saw provisioning increase by 60%. Despite that, our gross NPAs were flat compared to last year at around 1.77%. The net NPAs as of the year end stood at 0.28, and our provision cover remains possibly the best in the industry at 84%. So we continue to have what I would call a asset quality which is comparable or possibly among the best in the industry. In terms of the deposits, whereas the overall deposits were flat during the year, and this is because we raised both capital as well as availed of the special RBI window in December of last year to raise overseas funds. However, I'm pleased to say that our CASA at 33.5% remains the best among all South-based banks. And I'd of course like to point out that our CASA has a good blend. It's roughly half of current account and half of savings account. So for us, this is a very high quality CASA, and I'm pleased to say that this remains extremely steady. In terms of the other events during the year and the quarter, during the year we raised capital, as I mentioned. So we raised roughly 2,000 crores. As a result of which, our capital adequacy at the end of the year remains at 16.76%. So we have among the most solid capital adequacies in the banking system, and we do not foresee the need to raise capital in the near future. On the back of this result, the board has recommended an increase in the payment of dividend. It was at 55% last year. So for this year, the board has recommended 60%, subject to the approval by the shareholders. Overall, in terms of the environment, our sense is that the stress still continues. There are still challenges, but whereas we don't want to say that it has turned around as yet, but we are beginning to see some very, very early signs of green shoots. We continue to be very, very positive on the retail segment, but even on the wholesale segment, which as I mentioned, we degrew last year. For the coming year, we are certainly more positive than we have been in the past. So we would look for a acceleration in the growth, and we would look for a flattening out in terms of the asset quality.